Hi, in this video we are going to be talking about how to invest in a flat yield curve. India has had an unusual yield curve for quite some time now. Our government bond yield curve has been flat, which means that the difference that you would earn in investing for a 1-year period in a government bond versus a 10-year period or a 30-year period is quite less. And that's not what we would normally expect. We would expect a higher rate of return for an investment on 5 years versus 1 year or 10 years versus 5 years. So today we don't really have that in the Indian government market. What we do see is that the yield for the 1 to 30 year range is somewhere between 7.1 to 7.2%, and there's been some upward and downward shift, but it's by and large been at a very narrow range. So given that the yield curve is flat, how should we really think about investments? We know that today's yield curve is a bit unusual. So how are we going to get from a flat yield curve, which is what we have today, to a more normal one, which is upward sloping, right? There are two ways in which this could happen. The first is that your short-term rates actually drop drastically so that you still get that upward sloping curve with short-term rates being lower than current levels. The second way that you could get that is that short-term and medium-term rates stay somewhere where they are, maybe move a little bit up or down, but the long-term rates really move significantly to give you that slope again. Now, what happens in each of these cases? If short-term yields have to move down, then interest rates actually need to come down because short-term yields respond quite quickly to monetary policy action. But if we look at the RBI's commentary as well as inflation numbers that have come out for August, we are going to see that it doesn't look like you're expecting any rate cuts in the near future. So it's unlikely that your short-term yields are going to come down very fast. Now, if we look at the longer end of the spectrum, now long-term yields would go up because the government borrows a lot, or because your macroeconomic conditions are not so conducive anymore, or because we're spending too much money in terms of our fiscal deficit. So many of these macro factors could actually push your long-term yields well above the current level. Now, if we look at that, as of now, a lot of things on the macro front seem to be quite stable, and given overall global fiscal deficit numbers, I don't think India's is a negatively surprising number, even if we go a little bit overboard on the budget. But for the yield curve to normalize, either one of these two things has to happen or a combination of both of them. When long-term yields move up, what could happen for investors who invest in that space is that they might see some mark-to-market loss on their portfolios. So now we'll talk about how we can actually invest in a flat yield curve. The safest way to do this is to just buy high-quality short-term debt. This way, whether rates move up or down, you'll quickly readjust to the new normal, whatever that may be. You don't stand to lose too much because of surprises. The next way to approach this is to look at a more maturity matched strategy, which is, let's say you have a goal 3 years from now or 5 years from now, then you make an investment that aligns with your goal horizon. The next option is to actually look away from the Indian government bond yield curve and look at, say, corporate debt or high yielding credit, and there are different avenues in which you can do this. You could look at it through mutual funds, you could look at it through bonds, you could even look at it through AIFs. And the last option is actually to look outside of fixed income, and you'd have asset classes like equity and gold where you can structure some investments in these places as well. If you'd like to know more about investing in a flat yield curve and how you can make your portfolio work for you, get in touch with us and we'll be happy to have a conversation.